Welcome to the award-winning Moneymakers podcast. I'm Jonathan Davis, the founder and host. For more than 6 years now, we've been providing comment and discussion about all the latest developments in the world of investment trusts, the stock market listed funds often called the City of London's best-kept secret. I'm grateful to JP Morgan Asset Management for their continued no-strings support, which enables us to keep the podcast free while preserving our truly important independent editorial principles. Please note that while our comments are well-researched and our opinions honestly held, we do not offer individual stock recommendations. This week on the podcast, it's my pleasure to have another chance to talk to Ben Conway, who is the head of fund management at Hawksmoor Investment Management, which is a firm of financial advisors and fund managers. Now, Ben's been on the podcast several times over the last couple of years, in particular talking about his role in the campaign to, I think it's fair to say, shake up the investment trust world a little, and also his integral part of the campaign to act on cost disclosure, try and force the regulators and the government to make the cost disclosure rules that affect investment trusts fit for purpose. So we're going to talk about that. We're also going to talk about some of the thoughts that are going through his colleagues' heads and his own at this moment about markets, where we are and where we might be going and what looks interesting at the moment. So Ben, I don't really want to start off with cost disclosure because we'd rather murdered that to death in the past, but we'll come back to that. But I'd like to start off by asking for your general perception of how the investment trust sector looks today in terms of its overall health. You made the point 2 or 3 years ago that a number of things were not going well. We saw the wide discounts and so on. What is your perspective now on where the investment trust sector is? It's smaller, obviously. We've seen a lot of departures from the investment trust sector. But how do you assess its overall health at this point?
Yeah, hello, Jonathan. Thanks very much for having me back on. It's a pleasure to be here. I think the sector is in a far better place than it was a few years ago. And most encouragingly, it's got plenty of room to improve. And that's what you want to see as an investor. You still want to see room for improvement because essentially that means we can make some more money. So why do I say that? Why do I say that the sector's in a much better place? Just let's look at it through the lens of supply and demand. I think the outlook for demand is a lot better, and supply has obviously shrunk over the past few years. And I think there's every chance that supply in the short term, at least, will continue to shrink. So let's just start with the supply side. Everybody, all your listeners, I'm sure, will be very, very aware of certain activist campaigns over the past few years. And these campaigns are still very live through actors, most clearly, such as Saba. And also, of course, actions on the part of companies themselves and boards themselves in terms of share buybacks, consolidations, mergers and the like. So all of these actions have served to shrink supply. And on the demand side, the reason why discounts had remained wide until very recently is that despite that supply shrinkage, demand was also shrinking as well. So you sort of had this persistence of discounts. Now we're starting to see the latest data out, and you've referred to it yourself on recent podcasts, that discounts are narrowing. And the reason why discounts are narrowing is because we're starting to see, I think, some demand returning. And it's demand from constituencies of investors where we had hitherto been seeing falling demand. And I'm thinking in particular here, for example, of wealth managers, and even, dare I say it, the likes of equity investors who are looking to buy some investment trusts that give them exposure to areas that they can't easily gain exposure to via the equity market. And so, simple supply and demand terms, that's what's going on and that's why it's a better place. But if I could use an analogy of the sector as a garden, I think that the garden used to be, this is not a perfect analogy because it's sort of saying that there's certain investment trusts are weeds. And I don't mean that, that's a bit harsh. But there are an awful lot of weeds in the garden. And I think that the garden's tidied up, sunlight's getting to a few more of the healthier plants, and there's room for the garden to grow in the sunshine with a bit of watering and to really bloom. And at the risk of torturing this analogy, I think there's plenty of decent fertilizer yet to be thrown and to stimulate growth in the form of new demand, which perhaps we can come on to later. And I'm thinking in particular there of the potential increase in demand or new demand from pension funds.
You made some good points there. I think it would be difficult to argue that the sector is not in a better place than it was. I think where there is still scope for some discussion is what's actually driven that. There has been your efforts and those campaigners like you who are attacking particular aspects of the way that the trust sector has developed. And then we've also got, as you say, other players like Saba Capital and so on. And then we've got the behaviour of boards themselves and how they've reacted to these conditions. Now, I think in the past, I've certainly said, I don't know to what extent you might agree with me, but I think there was an element of complacency on the behalf of some boards for a number of reasons. Things have gone very well for many years. And it's always difficult to notice that the weather's changed, if you like, until it's too late. But also, there has been a very high-profile campaign by Saba and one or two other activists as well now coming into view as well, more behind the scenes. Let's just start with Saba. Do you think that now, looking back, they have won control of their first investment trust, which is something that I think a lot of people were unhappy about initially, but they have won that thing. Do you think overall they've been positive of the sector? I mean, what we do know is they're not going to go away. So I guess to have a view about that is to say, if you think it's positive, they'll go on being positive, or if it's been negative, do you think that they'll continue to be a negative factor in all this?
So to answer your question directly, net positive. And the reason why I say that is that's not casting a judgment on some of the tactics that have been deployed. And I don't want to go down what is potentially a rabbit warren and eventually is a subjective judgment as to whether you agree with certain tactics or not. But I've always said about not just Saba itself, but other activists, nothing illegal is going on. All of these investors are doing is what these investors exist for, which is to take advantages of opportunities that are being presented to them. And if one doesn't like the actions of these sorts of investors, then perhaps one should do more to prevent the circumstances that lead to the opportunities which these sorts of investors can take advantage of. Again, I was just speaking analogies today. I apologise, quite boring, but I do think it's a really good one. They're like wasps. And no one wants a wasp at their picnic, but without wasps in our ecosystem, the ecosystem can't thrive. And I think that activists of this nature provide really, really effective discipline. And I think that it's due to the actions of these sorts of active investors that we've seen proactive actions on the parts of boards. So, for example, boards might be looking over their shoulder, be less complacent than they might be about, for example, a discount, and proactively start buying in more shares than they ordinarily would have. I think that's a very positive thing. Or they might be looking at other initiatives to, for example, increase scale to stimulate demand, to close the discount, etc. One comment I would want to make, though, about all this, it's tangential, Jonathan, but one of the more recent, not quite a campaign, but one of the views we wanted to put out there is that we do think lots of boards do deserve sympathy as well. I don't think we want to tar the entire community with the same brush, that people that are complacent, lazy, and therefore have somehow allowed, it's all their fault, they've allowed these discounts to go, because it's not just about poor capital allocation or suboptimal capital allocation and lazy directors, not. But as a result of the actions of activists, directors are having to spend, in some cases, an inordinate amount of time on their trusts. And one thing I would comment, it always seems to be over the festive period, which is particularly horrible. I'm thinking of one particular board, and given the amounts of money that these people are paid, they're not paid to be working close to 6 or 7 days a week for an extended period of time. So that's one thing. And so I think that in this current environment, we would be very sympathetic to boards being remunerated rather better. And the second thing is people often make the same sort of argument with MPs in Parliament. I think if you raise overall levels of compensation, then you're going to create a larger pool of talent from which to pick, and perhaps a wider set of skills that will then decrease the likelihood of discounts widening as a result of, I don't know, potentially boards not having every single set of skill sets, or perhaps not spending as much time as perhaps you would like on an executive board to be spending.
Yeah, I think that's an interesting topic. I mean, you could argue, I guess, that the way that boards are remunerated in normal times, if we can talk about normal times, there isn't a huge amount to do. It's an important job, but you're being paid for your experience as much as the amount of hours you're putting in, your ability to ask the right questions and to look at the numbers and come up with the right reaction to them. So I can see the case for some kind of remuneration that is linked to how much you actually turn up, you end up having to do. But I think if you just raise the overall level, you wouldn't necessarily get better people. And it would be very difficult to come down from that once you've done that. So you might find actually that that's eating into your cost ratio and so on. So I do agree with you. I think that if you end up in a situation where you have to work a lot harder as a director, then there should be some mechanism to allow you to be paid more. And I'm sure most shareholders would be happy with that. But I'm not sure that an overall general increase, once we get back to more normal times, if we ever do, would be justified. That would, I think, would be my take on that. And I think there's a deeper question that arises, and I'm very sympathetic to how difficult some of these situations have been for a number of boards. They have been quite difficult, they're complicated, and you're never quite sure what's going to happen next. But I think the deeper question is, we talk about the structural advantages of investment trusts, and there are many, and the independent boards are one of those. But maybe the fact that it does in practice seem to take quite a long time to react to changes in the external environment is actually one of the structural weaknesses of the investment trust sector. I don't know if you would agree with that or not.
Well, perhaps if you could give me an example of that structural weakness manifesting itself in being slow to react to the external environment and why that's particular to investment trusts. I'm not sure I do necessarily agree.
Okay, well, let's just think about, suppose you're entering a period which, as we know, the external world is changing. We may not have been clear quite how much it was changing, but I think we knew that inflation was going up and the central banks had got that wrong. We knew the Ukraine war was going to have an impact and so on. So the external environment was changing and people didn't know how long that would last. But then you're looking at the performance, say, of a manager who's done reasonably well, but not particularly well. And then you've got this issue of how long do we let them go on before we actually think about making a change. We can challenge them for so long, but in reality, you've got 4 board meetings a year. You look at these things, it can take quite a long time. And then you want to give them the benefit of the doubt for a period and so on and so forth. And that therefore takes time. And maybe you don't act as decisively as you might otherwise do. I'm not saying, by the way, that this is not still in a better position than if you are on the board of an open-ended fund, where those considerations never really apply. You're always worse off in that circumstance. But I do think maybe that there is a question here about how urgently and how quickly you can in practice respond to changes that may reflect on the way that the trust is being managed.
Yeah, I'm not suggesting you're saying there's a right or wrong answer there, but when you say 4 board meetings a year aren't enough for boards to necessarily react with the alacrity that you would like them to, I would sort of say, well, hang on a minute. If we're talking about an equity investment trust, or investment trust that's only invested in equities, I would suggest that one's minimum holding period for that, for you to judge whether it's been a successful investment or not, would be certainly in the years, over which time there's an awful lot of board meetings happening. I think quarterly board meetings are plenty frequent enough in that context. And I think there is a risk to overreacting. There is a risk to over-responding to the external environment. There's a couple of high-profile ones over the past few years where the boards did make a change at an inopportune time. And what the sector really needs is a wide dispersion of managers and styles. And that means that at any one time, the manager is going to be seen to be out of tune, perhaps with the external environment. That's not necessarily a bad thing if, through the fullness of time and through market cycles, the performance can reassert itself. The key is, in the meantime, that the board and the manager are communicating effectively to prevent, for example, something like a wide discount emerging because there's a widespread perception that the manager is out of tune and has lost it and needs to be sacked. And if you don't sack it, then people start being disaffected and leave, and then you get an active investor taking advantage, etc. You don't want that happening, I agree. But to me, that's a communication challenge. That's not a structural issue with the investment trust or a criticism that a board might not be acting fast enough. I think we should have trusts in a way that are not performing as well as others. That's the whole point of diversity. That's what a healthy ecosystem is.
No, I understand that. You need diversity of styles, you need diversity of approaches and so on, and you need to give people a fair run. But I think the only point I'm making is that if one looks back with hindsight, we know that there are things that the boards do and have done traditionally. But I think it's fair to say that until the last 2 or 3 years, I don't think many of them were taking much interest in stimulating new sources of demand. They were monitoring the performance of the manager, but they weren't necessarily saying, my God, we've got to get out there and we've got to find new sources of demand.
Yeah, now though I do wholeheartedly agree with you there. I think that at least until very recently, the focus in that regard, particularly on the part of boards, has been quite narrow. There's been a sort of a reliance on existing pools and a lack of innovation and imagination in terms of stimulating new pools of demand. I would definitely agree with you there. I think what you're also starting to potentially hint at is perhaps in some cases you might think there's too cozy a relationship between the manager and the board, which would then also not necessarily be healthy and would certainly not stimulate decisions that you might want to be seeing, such as a change of the manager. But on the flip side, and in defense of boards, well, not in defense of boards being too cozy, and you can't defend that, but all too often I hear from boards that we engage with, and we engage with lots of boards, not all of them simultaneously of investment trusts we own, I might add, but we're always in touch with quite a few boards at any one time. We always hear, you're the first shareholder that's reached out to us in goodness knows how many months. And it is really disappointing when I hear that, because it's saying that vast swathes of shareholder registers aren't engaging, I think, properly enough. I think that the fiduciary duty means that you should be meeting with boards at least, I don't know what the correct number of times is, once a year, once every 2 years, whatever it is, I don't know. But when you hear that, is it any wonder that you get some of this complacency if no shareholder is actually bothering to speak to the boards and express their dissatisfaction?
Yeah, I think that's a fair point too. I'm not saying it's just the board's fault. Of course not. And we know that things like the wealth manager consolidation, that's an external factor which complicates things for every board. What I'm trying to get at is that it's a complex and it's a dynamic situation. And I think what the last few years have exposed is that some boards are better at reacting to changes in the external environment than others. I wouldn't go further than that.
Yeah, I think that's spot on, Jonathan. This is one of the reasons, and we're going to touch upon this as we go through the chat today. There are lots of reasons why I'm so optimistic for the sector, more optimistic than I've been in years and years. And one of them is because there is still so much room for marginal improvement. And the point is that boards are so much more receptive to constructive engagement in this regard. And there's a lot more proactive reaching out to shareholders and consultations and awareness that they need to improve before they're told to improve. And so conversations that you might have with the board, your opening introductions, if it's a board you haven't spoken to ages, it's so much healthier from the get-go than it might have been 5 or 6 years ago.
Right. Well, let's come back then to the supply and demand issue. And you said, I think, that you thought that there was still going to be further supply contraction, but you also said you were positive about more sources of marginal demand coming in from outside, from different sources. Perhaps we could just dig into that a little bit. And let's start off with one issue, which is, do you think we'll ever get a new class of institutional investors or an old class of institutional investors coming back? In other words, I'm talking about pension funds. Do you think pension funds at the top end of the market capitalization, I think they'll have to be that level, do you see them coming back in any form? And if so, what will be the trigger for that?
I'm very optimistic. I'm not going to guarantee it, but I'd be very surprised if by the early 2030s, there weren't tens of billions of pounds invested in the sector from pension funds. I'll say that much. I'll be very surprised. It might not happen, but let me tell you why I think it might, and there's a good chance that it will. I know you sort of wince when I start going down talking about regulation or legislation, etc., and you probably think I'm going to turn all your listeners off. But if I may briefly just touch upon the pension schemes bill, is that okay if I just go very lightly?
We'd love it if you did it very lightly. Yep, absolutely. Good idea.
So one of the bits of the recent pension schemes bill that's been going through Parliament is the sort of controversial mandation powers. And the government were wanting to reserve some mandation powers to tell pension funds where they should invest. Understandably, lots of people are going, oh my goodness, don't you dare tell pension funds where to invest. Pension funds will invest where they get the best returns for their scheme members. Okay, well, it's good stuff. But in one important respect, the government wanted to reserve mandation powers if pension funds didn't reach 10% of their portfolios in private assets by 2030, something which they had already voluntarily signed up under the Mansion House Accord, which predated the pension schemes bill. So what the government was saying is, okay, we're going to limit our mandation powers to that part of the portfolio that's in private assets, and we'll only use them once, and we'll only use them if you're not at 10% by 2030. Let's just take one quick step back. Why have the company been doing this? Well, because what the government wants us to do is use long-term capital to stimulate investments in areas where there's going to be some really good positive externalities for the nation, for the country. For example, classic use, build out of social and economic infrastructure. And it's not just about benefiting the overall economy because, for example, savers into pension funds get tax breaks. It's not just about that quid pro quo, but it's also about the fact that you can get really interesting return streams from these sorts of assets, and they're diversifying return streams set against, for example, equity and bond risk. So there you go. That's that. But why am I talking about this? Well, when the pension schemes bill was first drafted, under those mandation powers, if the pension funds were investing in investment trusts or investment companies to access private assets, well, they wouldn't have counted towards the 10% limit in their first drafting. Thanks to the tremendous efforts of lots of people, but most significantly the famous baronesses, Baroness Bowles and Baroness Altman, absolute heroines. Again, they were brilliant on the cost disclosure and they were brilliant on this. Thanks to their efforts, the pension schemes bill was amended so that were mandation powers ever to be needed by the government, when the government went and opened the books at pension funds, if they were invested in investment companies, invested in private assets, it would count. So there you go. That took me a couple of minutes. Hopefully it wasn't too much. That is such a strong signal, Jonathan. That is such a strong signal. That is the government saying to pension funds, we want you to invest in private assets. You can do it via lots of different methods, including investment companies. Now, what are the various routes that pension funds can take? Why am I so optimistic that pension fund money will find its way into the sector? Well, because they've got lots of routes, and they can do it via sort of semi-liquid funds such as the infamous LTAF. Or the really, really big ones might just buy the assets themselves directly. But most of them will be doing it via a mandate. We'll be giving it to a specialist. And I think a lot of the time it is going to be via these semi-liquid funds like the LTAF. And they like these structures, which lots of people denigrate because they say there's a liquidity mismatch. So you put money into these things, and if you want it out, you can only get it out once a quarter, and might be only be limited to 5% of your capital or whatever. And the things that these things are buying are assets that you can't necessarily trade from a quarter to quarter, like a toll road or a hospital, etc. These are not equity. So people say, well, there's a liquidity mismatch. But the pension funds like them, understandably, because you don't have the sort of the share price volatility that investing in those same assets would give you via an investment trust. So the investment trust obviously has the NAV, but it also, you don't invest in the NAV, you invest in the share price. But here's the big but. Surely the sort of the structures like the LTAF and the investment company, they're not competing, they're not substitutes, they're complements. They're accessing the same underlying return streams, economic infrastructure, social infrastructure, the same sort of return streams, but in a different wrapper. And both of those wrappers have positives and negatives. And those positive and negatives are different areas. The big positive about the investment trust, all your listeners will be aware of, is that there's no redemptions or subscriptions. And so it's really nice long-term money where there's not necessarily forced sale of assets at the wrong time. The other big, well, I think it's a positive now, is that let's take the pension fund hypothetical £1. The £1 into an LTAF will buy you £1 of assets, but only 85p of that £1 would be in infrastructure type stuff or private assets. The LTAF will always have to maintain a liquidity buffer in the form, for example, of cash. So your £1 will buy you 85p of asset exposure that you want, and then 15p of cash. And you'll be paying fees on that most likely. In the investment trust, I think you know where I'm headed here. That same pound, let's buy some of the most fantastically run infrastructure trusts in this country at nice big discounts, with decades of track record, with exposure to toll roads, hospitals, prisons, nuclear. And your pound is buying you, even if they were trading at NAV, a bit more than £1 of actual asset exposure because there's a little bit of gearing there. But if you can buy them at a discount, well, your pound is buying you even more. So, but what you're having to give up there is the mark-to-market issue. So you're probably, I would like to think that the way a pension fund might start to think is in sort of fiduciary terms. Yes, let's have some LTAFs because that's the sort of exposure where I can put money in and gently take some money out, and I'm not getting much mark-to-market volatility. But I should also have alongside it some of these investment trusts because I get a bit more liquidity, and your liquidity might only increase if more and more pension funds think like this. But in terms of a fiduciary and fair value and value for money, at the moment, at least anyway, there's no contest, really. It's much better value for money in terms of bang for your buck. And fees, also, fees on investment trusts in terms of the management fees are really, really competitive as well. So when you look at, I'm trying not to mention names, but there's a fantastic array that are available to us. But, look at the bigger ones. You look at the likes of HICL, IMPP, 3IN. Let's look at some of the renewable energy trusts like TRIG and UKW. These are the ones that really should be attracting pension fund money because they would be buying very, very similar assets, just wrapped up in a different form and arguably more expensively. So I think that pension schemes bill amendment was the absolutely necessary, if not sufficient, condition for pension funds to start to become interested. Lots of work still to do, lots of education still to do, lots of marketing to this constituency of investors, lots of admission of the weaknesses and how we overcome those weaknesses of the investment trust wrapper. Still all of that to do. But let me tell you this, Jonathan, the AIC are very alive to this. And I think that you're going to see more and more boards who are equally as alive to this look to court that interest. So I think the future is really, really bright. And if we can be buying these sorts of trusts today on these sorts of discounts ahead of that sort of demand, so much the better.
Well, I mean, it's interesting from the point of view of the government. Let's look at that for a moment. The reason you didn't mention why they want to attract money into infrastructure, of course, because they can't afford to do it themselves. There's no kind of state sector way of doing it. But it's also disturbing that we should ever be in a position where investment trusts were excluded from the pension schemes bill, because that suggests there's a degree of, I don't know whether you call it blindness or prejudice against investment trusts of some form amongst regulators and government policymakers. It doesn't matter what the noun is, but they suggested there's some gap in their thinking about the advantages of investment trusts. And then I guess you'd have to also point out that insurance companies just have more lobbying power than the investment trusts do. And insurance companies obviously run a lot of pension fund money, a lot of it, and they also beginning to invest in private assets and LTAFs. And there's so certain conflicts of interest, shall we say, It may not be real, but they're certainly apparent anyway. Let's put it that way. But I think it's a great triumph that we've actually got government and policymakers and regulators to get this done. I just wonder whether those other factors may still actually prevent it turning into reality of flows into investment trusts.
I think there might well be an element of truth to lots of what you just said there, Jonathan. But I think what I will say is this. I'm pretty down on this country at the moment for lots of different reasons we don't need to go into and probably shared by many. But one of the great things about this country is, and I've seen it firsthand, and it's one of the huge advantages of the House of Lords, is you genuinely do have public servants. And when there is a wrong, then you have fantastic people who do jump on it and who do act for the greater good for very, very little personal gain to correct these things. Eventually, despite what you said, we did get the amendment, or for example, in the pension schemes bill, we did get the correct treatment for investment company expenses under cost disclosure regimes, under the new CCI regime. We got there in the end. It took a while, but we get there. If you have the right people, we do have the institutions in place that does enable change.
You've said already you're generally bullish about the outlook for investment trusts as a whole. And from what you've said, you have a particular view that infrastructure and renewables are going to do relatively well, if only because obviously they're still trading at big discounts, and those discounts will presumably come down if you're right about the background in terms of supply and demand. That's basically what you're telling me.
Yes, and I think we've already started to see it. I don't think it's because, let's say, because pension fund money's been coming in, but I think we're seeing the impact of cost disclosure reforms. It's happened. I think we're there. We're gently seeing it come through already. So yeah, what is it? I think across the sector X3I, what we have 9% roughly out from the mid-teens. I should know better, but I'm sure you do know better. I think it's there or thereabouts, isn't it?
There or thereabouts. I mean, I think it's fair to say that that is influenced a little bit just sort of mechanically by the fact that we've got the whole SpaceX situation and the valuations in some of the very large investment trusts that are invested in SpaceX. But yes, so Scottish Mortgage in particular. But you're right, the discount is definitely coming in, but it may not be coming in quite as fast as the headline figure says. But it is coming in, you're right. And that's good, and there may be room to go further as well. You are listening to the Moneymakers podcast. To keep up with every single item of news from the investment trust sector and all the latest share price, NAV and discount movements, why not try a subscription to the Moneymakers Circle, our premium content newsletter? You'll find there our in-depth independent profiles of more than 200 investment trusts and more commentary. Go to money-makers.co for more details. Do please like, subscribe and share through whatever platform you're using. As well as the usual podcast channels, we can also be found on YouTube, TikTok, X, Blue Sky, and most recently on Substack. Visit the website for more details. As you're allocating your money for your clients, you have a medium-term, longer-term perspective, of course. Do you have a view, though, about the current equity market situation? In other words, the valuations and all the excitement around AI and people talking about bubbles and so on, and the things overvalued and it isn't broadly based and we've been here before, and all those kind of arguments with which everybody is familiar. Newspapers like them because, of course, they're always a good story. Do you have a view in terms of that? Obviously, looking through, if you like, the very short term, you're happy to be quite heavily represented in equities, are you, at the moment?
Well, I wouldn't quite go that far. I mean, actually, if I may, giving a cheeky plug for our blog called the Crescendo blog, which we distribute via LinkedIn. I wrote literally on this subject today, talking about why we're so excited about our funds portfolios and referencing the fact that we're quite lightly exposed to some of these euphoric areas of markets. We make the following points, I suppose, is that we're not experts in this area. We just don't know how euphoric this is, how much of a bubble it is. We're not experts. What our sort of core skill set is in constructing portfolios and being positioned in assets where we think we've got odds in our favour. And that means investing in assets where we've got a nice margin of safety and, depending on the individual risk mandate, plenty of upside relative to that downside. Now, the great thing about markets right now, Jonathan, is that there's plenty looking beyond the AI-related stuff, where you're really having to make a call, I think, in areas that's really, really difficult to. I think it's just so hard to really know about whether certain areas of AI or space are going to be successful. It's so hard that we just choose to have relatively little of our portfolios exposed to it. But there are loads of areas that we do like. We've already touched upon certain areas of investment companies, but within equities itself, the feature of equity markets that we see that is been around for a few years and still there is valuation dispersion. And because more recently it's because of AI, but before AI it was sort of passive stuff and then the Mag 7, big companies are the most expensive ones in markets. So when you hear people talking about the US is expensive, they're talking about the index. And the reason why the index is expensive is because the big companies are expensive. And under the surface, there are lots and lots of cheap companies. And we find that really talented active managers can build portfolios with relatively little sector factor style risk relative to history. So anybody can build a cheap portfolio, but you might be having to take a great big dollop of sector risk or style risk or something. But because of valuation dispersion, the only really sort of factor risk that you're having to take in any sort of substantial size might be size, i.e. market cap, because the very cheapest companies are the very small ones. And you have a lot of UK small cap managers on the podcast, quite rightly, because the investment company sector is replete with fantastic managers. It really is. You had a very good one on last week. You've had fantastic ones on in the past. And I think you're really sport for choice in the investment company UK small cap sector. I mean, you'd be hard pressed to pick a bad one, if I was honest. And these people are building portfolios with their own individual processes and individual styles, but they almost all have the same thing in common, that it's cheap. And so the great thing about the investment company in the UK small cap sector is you combine a cheap asset class with really talented managers. The two things don't always go hand in hand, I should say. And actually, having identified the valuation dispersion across all regional markets, in some regional markets, I mean, we don't just buy investment companies, we buy open-ended funds as well. We actually struggle to find really good talent. So sometimes it's frustrating. We think we've got a good story, but it's difficult to find the talent. But in the investment company sector, UK small caps are great, really good European small cap managers as well, which we would highlight. But the reason why we're happy to be relatively healthily weighted in equities is because we want to take advantage of that valuation dispersion. And the one feature I would say about our equity exposure, it tends to be biased slightly towards mid and small, although we do have some large cap exposure, just so we have relatively little mega cap exposure.
The Investment Trust Index is up 22%, and that's ahead of the All Share Index, which is up 17%, and it's about 3 or 4% behind the S&P 500. So it's been a good year for any investors who've been in the right things, and I'm sure your funds have reflected that. But are you seeing evidence from your clients that they're all queuing up saying, how do we get our money into SpaceX, or are you going to be filling our boots with SpaceX or Anthropic or OpenAI or these things? Is there actually any pressure from the clients on that score?
Of our clients, no. I'm not sure how representative a sample that is, because our clients know how we invest and maybe we attract a certain type of client. But if anything, our underlying clients, who are financial advisors, I should add, rather than individuals, but they're sort of saying the opposite. They're all worried. They're all saying, God, this is all getting a bit silly, isn't it? And I think that some of the articles you're reading about SpaceX, well, what do I mean by ludicrous? But some of the things the SpaceX are doing in order to get listed, and the amount of money that's going to be chasing it, and the sort of weighting relative to its free float, and all these kind of tactical things, it's all just slightly distasteful is too strong a word, but you don't get much mention of valuation in any of these things.
With reason, yes, because the valuation is absurd by most conventional metrics.
And it's interesting to use that word absurd, isn't it? But it's not putting very many people off, or in fact, it's just not a consideration, is it? So for lots of our clients, if we were sort of trying to get exposure to this sort of thing, they might be quite alarmed. I suppose in a sense that's quite cheering, but it's a good job they are, because obviously we've been lowly exposed to some of these areas that have gone absolutely ballistic. So our performance over the past couple of months has been slightly pedestrian. But, you know, our job, as I said to you earlier when I was talking about what should boards and investment managers be doing when they're out of favour, your job is to communicate to clients that this is why you might be a bit more pedestrian, and we're lowly weighted to funds that are invested in SK Hynix and Samsung and all these kind of things, and the DRAM specialists and etc. that are just going through the roof. All I want to say in this sort of thing is, rather than do down people who are successfully investing in this area, and I think there's some great investors, we do have a small position in Polar Cap Technology, and they are self-confessed AI maximalists. You have them on the podcast a lot. Terrific investors. It's patronising to say they know what they're doing, but they do.
They've been doing it long enough. I think we can take a view about that.
And all I would say is that the observation I would make is that one thing that we've learned, and we do self-reflect quite a bit about what we get wrong. And when we look at how we could have done better, it's often via sins of omission. So it's what we could have owned. And what we recognize, and we're as guilty of this as anyone else, is humans are terrible at thinking in a non-linear fashion. So when you have something that is growing non-linearly, we always underestimate how fast that grows. It's one of the things that Bailey Gifford are well known for taking advantage of, for example. And Polar Cap are rightly identifying that you've got incredible non-linear growth in the ability of large language models at the moment. And if that non-linear growth is then translates into sales and earnings growth for these companies, then yes, a lot of these valuations could well be justified, and one has to keep an open mind. So instead of sort of sitting there and preaching and saying this is all going to end in tears, etc., and isn't this awful, we just say, look, it could happen. this could be something, but we've got plenty of other things that we can get exposure to where risk-adjusted returns, we think in the fullness of time, will be really, really acceptable. We just accept that we might have a little bit of exposure to this via really good managers like the Polar Cap team in a higher risk mandates. But for our lower risk mandates, such as flagship Vanbrugh fund, we're going to be very, very lowly weighted, and we just have to explain to people why that is.
Yes, I mean, I think one of the points that Ben Rogoff of Polar Capital Technology made when he came on the podcast a few weeks ago, he did say that the flip side of that is you've got to move very, very fast to catch the latest trend, or rather market sentiment, because, software stocks went down massively on one news item, then they bounced back again. And similarly with some other sectors as well. We're seeing that maybe about to start with the semiconductors, we don't know. But on the one hand, people say, well, it's a great time to be an actively managed fund manager because there's so many things that are cheap and you've got a dispersion of value. On the other hand, you've got to keep up with this very fast changing environment, and the chances are you're going to make some mistakes along the way, and it's therefore difficult.
Yeah. And not just that, it's also horrible because an active manager, you've got such high weightings in a very small number of very big companies in order to keep up with indices. So it's horrible in a sense for an active manager. But I think if you've got clients who are willing to be patient and look through just a simple year or so and give you a bit of a chance, then I think this valuation dispersion that I was talking about will really generate some really good returns. And maybe this being lowly weighted to semiconductor stocks or continuing to be will really cost you, or maybe it won't be so costly in the fullness of time. But I would just say, if you do want to have some exposure to this sort of thing, I'd much rather give it to the experts at Polo, Ben and Nick and co, and let them navigate AI bottlenecks than try and second guess them oneself. I'd actually be doing that. And also, I think just sort of segueing on to something else, Jonathan, if I may, is HG Capital, which is a fantastic set of investors that specialize in software investing, who've slightly been on the wrong side of this, and certainly in sentiment terms, and seen their share price come under a tremendous amount of pressure, came out yesterday with a huge backing saying that internal stakeholders at HG are backing this and massively increasing their investment in HGT. So there's plenty of room and plenty of really talented investors saying the impact of AI in certain areas of the stock market has been vastly overdone. I'm talking obviously there of software.
In which they own a lot, of course. Yeah, absolutely. But it is a positive sign. It's something that you can do to try and persuade shareholders not to follow the herd in running away from something. You're quite right about that. To invest a lot more of your own money is a good vote of confidence. Having described your approach for clients and a couple of funds you run, what do you make of what we used to call the quality growth investors, the Nick Trains and the Terry Smiths, who have really underperformed over the last 5 years quite badly after a very strong period when they outperformed? Have you still got lots of those in your funds? Do you think this is just a cycle, or do you think that it's reflecting some more fundamental changes in the environment, of which inflation and technological disruption would be a very big part, because the companies they own are the ones that many people think will be vulnerable to AI coming into play?
So we are valuation investors rather than value investors. And until very recently, we had a larger portion of our equity exposure in value, not because, as I said, because we're value investors, because value relative to growth and quality was cheap when you compare it to history. Now, you just obviously correctly identified that quality and quality growth type managers have underperformed for quite some time. So some months ago, we did a relatively substantial project for us of going on and kicking the tires and speaking to every single of those sorts of managers that we could and really stress testing just quite how cheap their portfolios were. It culminated in us gently moving away from value and more towards those sorts of funds. And we did buy one. It was an open-ended fund, I'm afraid, rather than an investment company. But it was only a nudge of the tiller. And the reason is that cohort of stocks had massively cheapened relative to the last few years. But when you really zoomed out, they'd really, we thought, just come back to sort of fair value-ish and had really worked off the post-COVID era excesses. Because you think of them underperforming, but it was really underperforming, having outperformed absolutely supremely. So on a sort of really stepping back, we didn't think it was anything more than sort of a gentle rebalancing. And then the secondary issue was then, well, what's the nature of the companies that they're investing in? Having looked at normal valuation metrics, you make that statement. And you're right. It so happens that these sorts of managers happen to be invested in more companies that are impacted potentially by these sorts of themes. And all they were doing there is just, it probably at the margin prevented us from doing a bit more. Because though we were really kicking and saying, right, you're saying these stocks are cheap, but they're still in this area, and then you just check their knowledge, it effectively just comes down to a subjective judgment. How significant these things are really going to be impacted by large language models and AI and the rest of it, and how badly their business models. So the way we respond to that is the margin of safety we require just expands a bit, because we can't necessarily trust whether these individual analysts or managers' sales and earnings forecasts are really going to be quite as pessimistic, shall we say, as they need to be. So it moderated the extent of our move towards that cohort of stocks. So yeah, it's not the strongest answer you could get, but I just got to tell you the truth. So no, we're not steaming into this area just yet.
I'm doing this from memory, so I may not be precisely right, but when Fundsmith started, I think it was on a free cash flow yield of around something north of 5%, getting on towards 6. Now it's on, I think, between 3.5 and 4, having been lower, gone under 3 at one point, which still have the same characteristics as before, but so much money had come into them that the free cash flow yield of some of these companies was declining. And so there is a valuation argument there. It's not just a style factor, but the style factors may be just reflecting the valuations we've got.
Yeah, I've just got to bring up small caps again, Jonathan, because this is the siren call of the small cap, is that when you look at valuation metrics that are appropriate for small caps against history, they're just screamingly cheap. It's very, very difficult not to have significant exposure. Or let me flip it on its flip side. You say, if I'm sitting in front of a client, say, well, why don't you have lots of this really cheap stuff? Why are you more heavily weighted in larger companies that aren't so cheap relative to history? We can maybe use Fundsmith as an example. It's a bit cheaper relative to the near term, but relative to the long term, it's nowhere near as cheap as it once was. And there are funds in the small cap land that go back far, far longer than Fundsmith do, and they're cheap relative to that really long history. So then you have to say, oh, well, because the macro environment and da. But it's very difficult to consistently predict the macro environment. It's much easier to have price on your side. And who knows when the macro environment will turn. And what we always say is that we don't know when it will happen. But when it does turn in small caps favour, we know that the upside is going to be really, really good. And we really like our clients to be well exposed to that when it happens. And in the meantime, the way we deal with the fact that small caps, particularly in the UK, have been awful for a long time and there's loads of capital flows, active to passive doesn't help, and blah, 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 blah. Well, we'll just diversify the portfolio and make sure we do have things in the portfolio that are going to perform well while we wait for small caps. It's just a portfolio construction problem.
The other thing which one can say is that over the last 18 months or so, or 2 years even, there have been some spectacular performers in the investment trust space triggering me on Seraphim Space, for example, which is a very small trust. And one of the issues I think about the sector, which I've banged on about in the past before, is that before we can say it's really back into rude health, we do need to see some new, smaller trusts coming to market, don't we? We want to shake out some of the less good stuff, but we do want to bring in some more new investment trusts that one day will be the great performers of the future. Seraphim Space obviously started very small, lost 60% in the first year and so on, but now come roaring back. Do you think that there are too many barriers to new investment trusts starting still at this point? What would it take to actually get a bit of replenishment of the sector once this constriction process has run its course?
Yeah, that's one area where I find it harder to be very bullish on. Because the areas, where I was talking earlier about money coming back into the sector, that money is going to be very much focused on the larger trusts. The ecosystem, to use that word again, the ecosystem you need to foster growth in those smaller companies is one where you've got all different sizes of investor. And I don't just mean retail institutional, I mean all different sizes of wealth manager and fund manager. And one of the problems with the UK's regulatory regime at the moment is that it's the regulatory regime that's driving a lot of the wealth management consolidation that in turn is driving higher and higher and greater liquidity requirements. And I'm thinking, for example, of consumer duty regulation, which is extremely well intended and designed to protect the consumer, but does place a really significant additional burden on firms in the forms of an extra layer of compliance and related architecture. I can see it at my own firm, for example. And as I said, it all provides, really good product governance and protection, etc. But it is costly. So I think at some point we're going to need a regulatory regime that allows smaller companies to thrive. And what I mean by that, smaller wealth management companies. But smaller wealth management companies and smaller fund managers aren't going to have such stringent liquidity requirements. So I can't quite see that happening yet. The other thing about the consumer duty environment is it's not just driving consolidation, but it's also what the FSA wants to see is consistency of outcome across wealth managers. So whereas before you might have a very large wealth manager that at the firm level has got tens of billions of pounds, you had their individual offices having quite a lot of independence and ability to construct portfolios that differed from the centre. And I think, again, because of the regulatory regime and because of companies, quite scared of differing outcomes. So you could have a cautious portfolio for Mrs. Smith in Hartlepool and then a similar risk-weighted portfolio for Mr. Jones in Truro. And if those portfolios were invested very, very differently, albeit in a well-intended fashion and according to risk profiles, if the outcomes are completely different, then maybe that company is going to have something to answer for to the regulator. So they're really shy of doing that. That's another reason why, consistency of outcome across these organizations is driving uniformity of portfolios, which again, if you're running a lot of money, requires lots of liquidity. So again, I think we're going to need some sort of slightly more, how should I say it? I don't think mature is quite the right word, but a recognition that diversity of outcome doesn't necessarily mean something bad has happened.
Au contraire. Yeah, absolutely. I couldn't agree more with you about that. It doesn't benefit anybody to have a lot of herding around the mean, if you like. That doesn't particularly help anybody, I don't think, because it tends to produce suboptimal results, I think, over time. Well, look, Ben, thank you very much for this conversation. I'd like to give you a last chance to tell us why you're basically optimistic and bullish about the investment trust sector. Just give us the 1-minute recap, if you like, and tell us what you're telling your clients as you go about that.
Yeah, thanks, Jonathan, and thanks for having me on. So for everybody out there, think about share prices as the function of supply and demand. And from the investment company sector at the moment, both of those factors are in our favour. I think supply is very likely to continue to reduce on the back of both activism, but also consolidation, and also on the part of boards who are improving in terms of capital allocation. So you look at share buybacks. And then on the demand side, I think as a result of cost disclosure reform, you're seeing a gentle return, for example, from wealth managers and fund managers who are benefiting from correct cost disclosure. In the fact that they invest in an investment company and it no longer punitively inflates their ongoing charge figures. And also over the longer term, thanks to recent amendments in the pension schemes bill, it's a strong signal that over the next few years, the probability of pension funds coming in to gain exposure, particularly to private assets for our investment companies, increased markedly. So given that investment trust discounts already narrowed a bit, but still wide relative to history, I think we've got a fantastic forward-looking environment for good returns from all sorts of investment companies.
Well, let's hope that's the case. So that was Ben Conway, the head of fund management at Hawksmoor Fund Management, speaking to me on Friday afternoon, just as the global markets are, having a little second thoughts maybe about the impending SpaceX flotation. They've sold off a little bit in the last 24 hours or so.
Thank you for listening to the Moneymakers Investment Trust podcast, sponsored by JP Morgan Asset Management and independently produced and edited by Moneymakers. If you like what you have heard, do tell your friends and colleagues, and remember to subscribe through your favourite podcast app or at the website so you never miss an episode. And follow us on our social media channels. For more news, commentary and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription. All details are at the website money-makers.co. Podcasts are provided for educational purposes only, and nothing you have heard from any speaker should be regarded as constituting investment advice.